A reverse home mortgage is a unique financial tool designed to help older homeowners convert part of the equity in their homes into tax-free income without having to sell their home or make monthly mortgage payments. Unlike a traditional mortgage where the borrower makes payments to a lender, with a reverse mortgage, the lender makes payments to the homeowner. This product is primarily aimed at retirees who have built up substantial equity in their homes and are looking for a way to supplement their income during retirement. In this video, we will explain what a reverse mortgage is, how it works, who can qualify, the benefits and potential risks, and how to apply if you decide it's the right option for your financial needs. A reverse mortgage allows homeowners aged 62 or older to borrow against the value of their home. The most common type is the Home Equity Conversion Mortgage, or HECM, which is federally insured by the Federal Housing Administration, HA. With an HECM, borrowers can receive funds as a lump sum, monthly payments, a line of credit, or a combination of these options. The loan is repaid only when the borrower sells the home, moves out permanently, or passes away. At that time, the proceeds from the sale of the home are used to repay the loan, and any remaining equity goes to the homeowner or their heirs. To qualify for a reverse mortgage, a homeowner must be at least 62 years old and either own their home outright or have a small remaining mortgage balance that can be paid off with the proceeds from the reverse mortgage. The home must be the borrower's primary residence, and they must continue to live in it for the loan to remain in good standing. Eligible properties include single-family homes, 2 to 4 unit properties with the borrower occupying 1 unit, HUD-approved condominiums, and certain manufactured homes that meet FHA requirements. Borrowers must also meet financial requirements, including the ability to pay property taxes, homeowners insurance, and maintenance costs. Before applying, they are required to complete a counseling session with a HUD-approved counselor to ensure they fully understand the implications of the loan. This session is designed to educate borrowers about the benefits, risks, and alternatives to a reverse mortgage. It also gives them a chance to ask questions and make an informed decision with the help of a neutral third party. The amount a homeowner can borrow depends on several factors, including the age of the youngest borrower, the home's appraised value, current interest rates, and the specific payout options selected. Generally, the older the borrower and the more valuable the home, the more they can borrow. The FHA also sets a maximum claim amount, which limits how much can be borrowed regardless of the home's value. This amount is adjusted periodically to reflect changes in the housing market. One of the main advantages of a reverse mortgage is that it provides a steady stream of income or access to a line of credit without requiring monthly loan payments. This can be especially helpful for retirees living on a fixed income who need additional funds to cover healthcare costs, home improvements, or everyday expenses. Another benefit is that the funds received from a reverse mortgage are typically tax-free, as they are considered loan proceeds and not income. Reverse mortgages are non-recourse loans, meaning the borrower or their estate will never owe more than the home is worth, even if the loan balance exceeds the home's value when it is sold. This feature protects both the borrower and their heirs from being financially responsible for any shortfall. If the home sells for more than the loan balance, the excess funds go to the borrower or their estate. However, reverse mortgages also come with potential drawbacks. Because the interest and fees are added to the loan balance each month, the amount owed increases over time. This can significantly reduce the amount of equity left in the home, which may impact inheritance plans. Additionally, if the borrower fails to meet the loan requirements, such as paying property taxes, maintaining homeowners insurance, or keeping the home in good condition, the loan may become due and payable. Costs associated with reverse mortgages can be substantial and include an origination fee, mortgage insurance premiums, closing costs, and servicing fees. These costs are typically rolled into the loan, meaning you don't pay them out of pocket, but they do reduce the net proceeds available. It's essential to understand all associated fees and how they impact the overall loan balance over time. Applying for a reverse mortgage involves several steps. First, the homeowner must schedule and complete a counseling session with a HUD-approved reverse mortgage counselor. After the session, the homeowner receives a certificate of counseling, which is required to proceed with the application. Next, The homeowner selects a lender and completes the formal application. The lender will then order an appraisal of the property to determine its market value and ensure it meets FHA guidelines. Once the appraisal and necessary documentation are submitted, the application goes through underwriting, where the lender reviews all information to assess the borrower's eligibility and finalize the loan amount. After approval, the homeowner signs the loan documents and chooses how they wish to receive the funds. There is typically a 3-day right of rescission, during which the borrower can cancel the loan without penalty. Once the loan is funded, the homeowner begins receiving payments based on the option they selected. Throughout the life of the loan, no monthly mortgage payments are required. However, the homeowner remains responsible for all other homeownership obligations, including taxes, insurance, and maintenance. It is important to understand that failure to meet these obligations can lead to foreclosure. Many homeowners choose a reverse mortgage not only for the immediate financial benefits, but also for the peace of mind it can bring. Having access to funds when needed can help seniors age in place and maintain their independence. For some, it's a way to delay drawing down other retirement assets, such as IRAs or 401k plans, allowing those accounts more time to grow. For others, it may provide the ability to make home improvements, travel, or help family members financially. Still, it is crucial to consider alternatives before committing to a reverse mortgage. Depending on your situation, selling the home and downsizing, taking out a home equity loan, or seeking assistance from family may be better options. Talking with a financial advisor, estate planner, and reverse mortgage counselor can help you weigh the pros and cons and determine whether this product aligns with your long-term goals. It is also important to involve family members in the decision. Since a reverse mortgage affects the value of the estate and could impact inheritance, open communication can help manage expectations and prevent misunderstandings. Children and heirs should be informed about the terms of the loan, the repayment process, and their options when the homeowner passes away or moves into long-term care. In summary, a reverse home mortgage can be a valuable financial tool for older homeowners who want to access their home equity without selling or making monthly payments. It offers flexibility in how funds are received and protects borrowers from owing more than the home's value. However, it also carries costs, reduces home equity over time, and requires ongoing responsibilities to remain in good standing. By understanding how reverse mortgages work, who qualifies, and how to apply, you can make a well-informed decision that supports your financial security during retirement. Always consult with professionals and take the time to explore all available options before moving forward. If used wisely, a reverse mortgage can offer the financial freedom and stability many seniors seek in their later years.